You know, I hesitate to say that everybody knows Stuwart. I think they do, but I got to tell you, we've got an asset in Stuwart Powell in this association that is unlike anything else in any other state association. He is known across the country for his technical ability, for his knowledge, for his depth, and number one, for just being somebody that you can talk to and you can understand the issues from. But let me formally introduce Stuwart, and he's going to lead our panel. Stuwart, Vice President of Insurance Operations and Technical Affairs, where he oversees the association E&O and Employee Benefits Program. He manages the North Carolina Association of Insurance Agents, the exclusive insurance agency for the state of North Carolina. He's also a valuable resource for members, providing technical support and information. Stuart's well known across the country for his experience, and he regularly teaches for the IIANC as well as other insurance organizations. He's a national faculty advisor for the Society of Certified Insurance Counselors. Please welcome Stuwart Powell.
Thank you, Tim. I started to fall just so that if the chair falls, I guess staff ought to fall in sympathy with that. So, but anyway, it is my pleasure today to introduce a panel of a very diverse panel to discuss this issue of the property problems in North Carolina. And so I'm going to call them up one at a time. I'm going to read you their the introductions as they come up. And the format for this will be, once I make a few introductory remarks, we're going to have each panelist come up to the podium and make about 10 minutes or so of sort of a position statement from their perspective. And then after that, the panel will be reseated, and we will take questions from the floor. So if you have questions, there are pads and pencils, paper at your desk. Please write those down, raise them up, and a staff person in the back of the room will get those and bring them up to me so we can kind of control the flow of those questions. First, I'd like to introduce Tommy Cook. No, excuse me, Gina, I'm sorry. They got Gina up on the screen. Let me do Gina first. Gina Swissgable has 25 years of extensive experience in the insurance industry. She was one of the things that made Gina what she is she used to be my underwriter a number of years ago. So she has recently been named the general manager for the North Carolina Joint Underwriting Association and the North Carolina Insurance Underwriting Association, which are our beach and fair plans, which provide insurance coverage to more than 250,000 policyholders in North Carolina and generate an annual premium of just under $330 million. Gina spent 15 years of her career with Great American and Ohio Casualty as an underwriting manager, as a business center manager, national umbrella products manager, and as assistant vice president. In 2006, Gina accepted the position of assistant vice president with Builders Mutual, where she was responsible for establishing and managing all underwriting policies, practices, and procedures. Gina, would you come up and take your seat, please? Secondly, I would like to introduce Tommy Cook. Tommy is an independent agent here from Myrtle Beach. Those of us that have been around the association business for any length of time have gotten to know Tommy over the years, and what a contributing factor he's been. He's worked in the insurance industry since 1973. Tommy and his wife Bonnie opened the John T. Cook Associates in Myrtle Beach in 1983, and they still manage that agency today. Tommy has been involved in the insurance industry during his career, dedicating 15 years of service to company and association boards. He has served as both president and national director of the Independent Insurance Agents of South Carolina. He has served on several insurance company advisory boards and has served as the national chairman of the advisory board for the Harleysville Mutual Insurance Company. Tommy is also the recipient of the 2005 South Carolina Independent Agent South Carolina Agent of the Year Award, and in 2008 the IIABA, the National Association's Chairman's Award. So Tommy, would you come up and take a seat, please, sir? Next, I would like to introduce Willa Kelly. Willa is the Government Affairs Director for the Outer Banks Association of Realtors and the Outer Banks Home Builders Association. In addition to advocating the legislative policies for each association for 6 years, she publishes a weekly legislative briefing that is distributed to over 1,400 members, keeping them up to date on local and state issues. She is a founding member and president of the NC20, a coalition of individual business and government entities that work to further the common environmental and economic development interests in North Carolina's 20 coastal counties. Willa has testified before the North Carolina Legislative Study Commission on property insurance rate making, given presentations to North Carolina legislators, and has become a leading speaker on issues throughout eastern North Carolina. Willa, would you come up and take a seat, please? And last but not least, I'd like to introduce John Maletti. We've gotten to know John very well over the last few years and worked very closely with John on a number of issues that have affected us in North Carolina. John currently serves as the Vice President of Governmental Relations Vice President and Governmental Relations Counsel for the Travelers, where he is primarily responsible for managing travelers' personal insurance, legislative, and regulatory affairs countrywide. John currently serves on the governing board of the Texas Fair Plan, the South Carolina Wind and Hail Underwriting Association, the North Carolina Beach and Fair Plans. He received the Independent Insurance Agents of North Carolina's Company Professional of the Year Award in 2009 for his efforts relating to beach plan legislation. He's also previously served on the governing boards of the Louisiana Citizens Property Insurance Corporation and the Texas Wind Insurance Association. John Maletti, please come up and take your seat. Okay. Let me sort of get this discussion started a little bit. I want to say a couple of brief things. I'm not here to be an advocate for any particular position, but more a moderator. But just to sort of set the stage, there is one of the things that we are being told by insurance companies now, and with great rapidity, is that weather patterns are changing and becoming much more difficult to predict. And those of us in the business know when the volatility of predictions tends to increase, that makes pricing the risk far more difficult. The other point I wanted to make was that over the last 2 years, we have had some of the more severe catastrophic losses that the industry has suffered in the history of the industry in North America. And many of those losses have been wind-related. Not all of them, but many of those losses have been wind-related. And you can see by those numbers on the screen the magnitude of some of these catastrophic losses. And the last thing I want to show you a chart that appeared in Best Week in the first week in February of this year. It is a map of the United States, obviously, and it shades the 11 states that at that time had gotten 18% or greater rate increases since December the 1st. That would have been 2 months, from December the 1st to the end of January. And I don't have to point out to you what is interesting about that chart. Without further comment, at this point, I want to bring up Gina and let her share her information on the North Carolina Beach and Fair Plans with you. Thank you very much.
Good morning. It's my pleasure to be here with you and to assume the role as general manager. I took this position on January the 31st of this year. And the one thing I really like about the position is getting the opportunity to work with all the independent agents. My father actually was a small independent agent in Georgia, so I have a lot of respect for what each of you do on a daily basis, working with your clients and making sure that they have the right coverage. And then also getting to work with the direct writers, getting to work with the insurance industry. I've been extraordinarily pleased with my board and how much each of them take their responsibilities very seriously in terms of making the best operations of both plans for the state of North Carolina. First of all, I'd like to recognize my staff that's here with me today. First of all, is my right-hand person, Lee Dunn, the Assistant General Manager of both associations. Next is Bob Eads. Bob Eads is new to the association, newer than us to run our claims operations. And lastly, Alvin Ashworth, and Alvin Ashworth runs all of my accounting and finance. I'm happy to have all of them here with me today. First of all, I'd like to talk about nomenclature because you'll hear us refer to the plans in a couple of different names. So for the FAIR plan, you might hear it called the NCJUA. You might also hear it called the North Carolina Joint Underwriting Association, or lastly, the FAIR plan. The next association you might hear called the Beach Plan. The General Assembly did change our name to the Coastal Property Insurance Pool, so on a lot of my slides today, you'll see me adopting the nomenclature from the General Assembly. You will also hear it referred to as the NCIUA or the North Carolina Insurance Underwriting Association. So all of those names going with the Coastal Property Insurance Pool. First thing I'd like to start with is what is the purpose? And we try to stick very closely to the purpose that the General Assembly has established for us, which was to provide an adequate market for essential property and support of the economic welfare of both the beach and coastal communities, and that without such of a facility for insurance, that growth and development in those areas would be severely impeded. Also, to make sure that the market, the General Assembly acknowledged that the market for such insurance was not adequate, and they also acknowledged that in the future it might become less adequate. The General Assembly acknowledged also in their declaration that the intent of creating it, they understood that changes would have to be made as they evaluate and try to continue to let us augment the market, being the market of last resort, as opposed to being a direct competitor with the private market. When you look at our creation, we were created in the 1960s, and if you think back of what was going on in the 60s, you had a pullback of capacity from the private market as riots were going on in some metropolitan areas. So you had 27 states go about creating a FAIR plan, and we were one of those states. You also had problems with capacity on the wind side, and the problems with capacity on the wind side, some states reacted to the Camille hurricane. So in 1969, the NCIUA, or the Coastal Property Insurance Pool, was created by the General Assembly. Other things to note that right now, with the legislation that occurred in 2009, our member companies do not receive any profits back from the association. However, they do provide us $1 billion of an aggregate cover if our funds that we have on hand are inadequate to cover the losses that might occur from a major event or multiple events that occurs to the state. Our board of directors is composed of 7 members from companies that are elected annually. We also have 4 insurance agents, 4 agents on both our FAIR side and 4 agents on our beach side. At this time, I wanted to read out the names of those agents because serving on both the beach and the FAIR plan really takes a lot of dedication, and this year the agents have done so much to help me on the reinsurance front, looking at alternate financing, looking at operations. And so those agent representatives are Elmer Midget for the FAIR plan, Jimmy Goins for the FAIR plan, Richard Heckel, who is here today, Murray White, and then on the beach plan we have Charlotte Hicks, Rod Evans, Don Evans, and Fletcher Willie, and special thanks to all of you. Some of you are in the audience today that serve on there. I would also tell you that our company members, our operating expense ratio at our association runs 2.65%. That's significantly lower than any other plan in the country, and I think a lot of that has to do with the partnership we have with the member companies and the partnership we have with our agents and our public members. For example, State Farm came in and helped us to redesign our phone system and helped us to give us technical advice for our phone system, and regularly we get that kind of partnership from our various companies in supporting the associations. And John Maletti and his group actually helped us review our reinsurance contracts this year, and we really appreciated that. The Coastal Property Insurance Pool, what do we cover? A lot of times people think that the 18 counties are all the NCIUA or all the beach plan, and the FAIR plan is everything else, and that really is not the case. The FAIR plan covers fire for everything except for the small beach area. coastal property insurance pool covers dwelling fire, commercial fire, and that's how it started in 1969. In 1988, we extended to wind only for the beach areas. In 1998, we extended wind only to the coastal areas. And then in 2003, we provided a homeowner's product for both the beach area and the coastal areas for the homeowner's product. The FAIR plan still covers the dwelling and commercial fire for all territories except those territories right at the beach, and that's where you see the overlap occurring between the two plans. We do not set rates at the association. We follow, being the market of last resort, we follow ISO manual for both of our commercial wind product, and for our commercial fire product. For our dwelling wind and homeowners wind, we follow the rate bureau plus a 5% surcharge, and our homeowners, we do a 15% surcharge over the rate bureau rates. The maximum policy limits for the NCIUA are $750,000. For residential contents, it's 40% of the building limit. Commercial, we do $3 million per fire division with a $6 million aggregate, and we do have a 1% named storm. What you see here is a visual depiction of the 18 counties that we write in. The next slide is the rating territories, and if you look and you see rating territories 7 and rating territories 8, those are the beach areas, and the rest of the area is the coastal property pool. How does the growth in the plan look this year? For full coverage for the coastal property insurance pool, we're actually slightly down by 0.39% as of March. For wind only, so that companies would write the primary coverage and we would write the wind, we're up 8.35% for a total increase of 7.10% this year and $74 billion in insured values. The FAIR plan exposure, this is where you're seeing equal growth from both the 18 coastal counties and also from the remainder of the state. So through March, we're at 8.11% growth in the coastal counties and 8.19% growth in the other counties in the state. How does the exposure comparison look when you look from January of last year to January of this year? We're up 5.5% on our exposure comparison, having $76 billion in insured coverage. Our premium at $329 million, and we're only up 0.8%, so our exposure growth you can see is up 0.5%, whereas our premium increase is up less than 1%. Our policy count is up 3.7%, and our location count is up 3.3%. How does the exposure look per county? And what you can see from this graphic is you can see what areas and how many billions of dollars we have in cover in each of the counties. So when you look at the red, you will see that represents $5 billion to $18 billion of insured values in those areas that are red. The last graphic that I have for you is basically the risk financing structure. And when we're looking at the risk financing structure and how much premium we're going to allocate to reinsurance, I tell my board, you know, you really can only be wrong. And what I mean by that is if no hurricane occurs, why did you spend so much money on reinsurance? And if a hurricane occurs that happens to go through our tower, well, why didn't you spend more on reinsurance? So they are looking at a lot of data points. They're looking at several models. They're looking at a lot of data points to try to allocate funding between 4 points that we ask them to allocate funding between. One is we have normal expected losses. Because we write full peril policies, we're going to have fire losses that we also have, and we call that attritional losses. So we've got to allocate money for attritional losses. The next thing we have to allocate money for is the large event. The third thing we're allocating money towards is a second storm. How do you cover a second storm? And if you'll look on the tower, you'll see that the member company assessment and our first layer of reinsurance is essentially on an aggregate basis instead of a per occurrence, and that's how we're looking at covering the second storm. And the fourth thing that you look at is the surplus, is how much can we add to surplus in any given year. So when you look at this tower, what we're trying to do is get past the 100-year storm, 100 years or greater. And on a blended models of the models that we've looked at, this gets us somewhere around 110 years. And if you look at it, I also look at non-exceedance. And what non-exceedance means is, what is the probability in this storm year of us exceeding or having a hurricane that occurs that would blow through this entire tower? And this entire tower for the state of North Carolina should handle 99.76% of all events that occur in the state. Now, there's still that 1/5 of 1% that at that point we would have to look to the legislature probably for more bonding opportunities or other sources of financing, because this is all that the plan has open. But again, it covers 99.76% on an any given year basis, and we've allocated money to every area which the plan needs to allocate money towards. Thank you for the opportunity to talk with you, and with that, let's look at South Carolina.
Thank you, Gina. Next, we're going to have Tommy Cook come up. Tommy, as I said, is an agent in Myrtle Beach, and Tommy is very knowledgeable about the South Carolina wind pool and is going to give you some comparisons with what Gina has showed you. Thank you, Tommy.
Good afternoon. When I was first asked to come and speak with you folks, I was very excited about it. I appreciate the invitation. I know a lot of you out in the audience. I've spent a lot of time on boards and in meetings with you. But the neatest thing I thought is most of you don't deal with the South Carolina Wind and Hail Association, so I can actually get up here and tell you stuff, and you don't know whether I'm telling you the truth or not. But I'm going to try to give you a very broad picture of the wind pools, and y'all can do some comparisons of your own. First of all, the makeup of the wind pool is basically an association of insurers that are licensed to do business in South Carolina. It is mandated by law that they do that, and they are responsible for any shortfalls and the losses that occur. It is not a state agency. There are no state funds given to the wind pool, and they have no liability exposure either. Okay. I think I skipped too fast. Hang on. No, it's not the next slide, but anyway. The wind pool is a $100 million insurance company with 47,000 policyholders and $17.4 billion in insured values. The rate and forms are filed to the Department of Insurance for approval, but they do get the input from the state consumer advocate. The board follows the director's lead on any consumer issues, and actually the wind pool started in 2007. It was mandated that they have annual meetings on the coast of South Carolina. We just had one recently in Myrtle Beach. The wind territory is set by state law. It's not decided by the wind pool. It was recently expanded in 2007. The director has the authority to expand it for a 2-year period, and it's renewed every 2 years, so currently it's expanded until 2013. You can see from this graph, hopefully, the red is the real concentrated areas along the coast where the wind pool rights. It is a very small territory. Originally, when it was set up, it was all business basically east of Business 17. And it was you can be 1,800 feet from the ocean or you can be a mile, but it's a very small territory. In 2006, when we had a capacity crisis, it was expanded to the waterway, and that's where it is currently. The old territory is Zone 1, and the new territory is Zone 2. It is a wind and hail only pool. We don't write fire or any other perils. We obviously encourage people to carry flood insurance because they're usually very close to the coast. There are no automatic renewals. You have to rewrite the policy each year. There has to be cash up front, and if it's a new business, there has to be photos submitted. On the underwriting side, the maximum limits for personal lines is $1.3 million. That includes building contents and loss of use. The commercial is $2.5 million. That also includes building contents and any business income that may be written. The deductibles, there's a mandatory 3% minimum wind deductible in Zone 1 and a 2% in Zone 2, and you have options, as you can see there, up to 10%. The only exception is on a homeowner's policy, you do have a 1% named storm deductible. There is also a waiting period, right slide, 15-day waiting period. Smitty Harrison, who runs the Wind Pool Board, is very proactive in making things better for the Wind Association. And several years ago, we had 4 or 5 storms coming off the coast of Africa, and they were just like a train, just one right after the other. And we would get an email saying, you know, we're open for business, and next day, no, we're closed. And then we're open, no, we're closed. So we went to Smitty with the idea of doing what the flood program does and coming up with a waiting period. So there's a 15-day waiting period now on the wind pool. The only exception is if you have a closing and there's a mortgagee involved, you can get coverage bound without the waiting period. And on the rewrites, you do have a 5-day grace period. On the indirect coverages, the loss of use coverage is 20% of coverage A on a dwelling or homeowner's policy with an option of 10%. Loss of use on a HO4 or an HO6 is 40% with an option of 20%. On the business income for commercial, it's the lesser of 150% of coverage A or $500,000 with an option for $100,000. And if it's just contents, you have 200% or $500,000, whichever is less. On the underwriting factors, the main thing they look at is housekeeping and condition, primarily of roofs. They do an inspection on every single property, and they do look very closely at the roof. The property cannot be located over water. There can't be any violation of state laws. Has to be insured to value, and there's a flood requirement only on primary residences. If you want to get replacement cost coverage on your primary residence, it does require a flood policy. Things that are not a factor or loss history, it doesn't matter how many claims you've had, doesn't matter how close you are to the water. There's no requirement on commercial and other personal property other than the primary residence to purchase flood insurance. Doesn't matter if you consider yourself a good person or you know your agent very well, have a good agency relationship, it just doesn't matter. On the income and expenses, you can see from this graph that in 2006 and 2007 there was a bump in commercial when we had the capacity problem. The free market came back and all the E&S companies started writing at better rates. So you can see that the commercial in 2012 is about the same level it was back in 2003. Most of what's in the wind pool are personal lines. Primarily, I think, we have a lot of homeowners carriers that have come in from Florida and other places to write homeowners' primary residences in South Carolina. I think most of that personal lines is probably dwellings and HO4s, HO6s. The most important fact about the wind pool is that they can pay the loss of a major storm. They buy reinsurance that's automatically reinstated each year, and they can pay for a 1 in a 200-year storm. And that is all I have for you guys.
Thank you, Tommy. Now we'll have Willa Kelly come up and give us more of a consumer's perspective on the property markets in North Carolina.
All right. I, too, thank you for allowing me to come here and speak to you today on the perspective of the consumer. Of course, I'm going to discuss with you the perspective of a consumer in eastern North Carolina, where, as we've seen more and more over the last several years, that the market of last resort in the beach plan has become our market of only resort when it comes to wind coverage. Just by hand, how many of you actually are involved with policies in eastern North Carolina? Okay, so a lot of you are already going to be aware of what I'm going to tell you today. For those of you that don't write policies in eastern North Carolina, I hope maybe you'll take away something from this today, because what I found in my last 4 years of working on homeowners insurance is there's a lot of misinformation out there, a lot of quote-unquote myths on how coverage is handled in eastern North Carolina. We all know and are fully aware that access to coverage, affordable coverage, is a huge issue for us in Eastern North Carolina. It has been since 1993. 1993 was the first year that modeling was used to determine rates in Eastern North Carolina. It was a consideration then, the first public hearing that was held on a rate filing, and the only public hearing that was held on a rate filing up until 2011, when there was a public hearing held from the Department of Insurance on a dwelling rate filing. As you're aware, insurance is the balance between covering risk and the ability of a policyholder to pay for the coverage of that risk. You're in the business of risk, and what I've seen over the years is we seem to be backing away more from being the business of risk and turning more towards where we're looking at profit and ensuring a profit year after year, and instead of spreading risk across a wide area and looking at good years versus bad years, that risk has now turned down to a business model where we're looking at every year paying for the worst catastrophic loss. So we have several issues. Statewide rate inequity, certainly you've heard about that. We pay very high rates in Eastern North Carolina. We pay up to 5 times what people are paying elsewhere, but the bottom line question is, do we pay our fair share? The rate filing on homeowners insurance that was done in 2008, we researched that fully, scrutinized it, had several meetings with the Department of Insurance and legislators on that. We found that based on the settlement that was reached by the insurance commissioner with the Department of Insurance, 33 counties in the city of Charlotte are paying less for rates than they did in 1993. At the same time, consumers in Eastern North Carolina are being told that rates are increasing because of increased construction costs, et cetera, et cetera. We found it odd that 33 counties in the city of Charlotte pay less in rate than they did in 1993. Do we pay our fair share? We looked at the loss experience that was included in that 2001 to 2005 data that was in that rate filing, and we found that Eastern North Carolina as a whole in 18 counties, not just those policyholders in the beach plan, only incurred 10% of the state's total losses. When we further scrutinized the rate filing and looking at premiums earned versus losses, and just looking at incurred losses versus premiums earned. Now, premiums earned specifically were not included in the rate filing, but applying the average rate over the 5 years as to every consumer, every policyholder paying the maximum rate. Dare County takes a beating a lot of times because that's where you see the picture of the Pine Island homes and the large kind of McMansions, as they're called, and how, you know, all of the exposure must be, you know, those type of homes, and I can guarantee you it's not. Actually, the largest portion of the beach plan exposure is in the inland areas for wind coverage. So when you look at those, what was paid there, we found out that based on just losses, do we pay our fair share? It was 6 cents on the dollar went to pay for losses based on that formula. In Dare County, 22 cents on the dollar in the same area that got a decrease in Buncombe County went to pay for losses in that territory. So do we pay our fair share? We need to dispel that myth that in Eastern North Carolina we don't pay our fair share, because based on that rate filing, yes, we do. Rates, of course, are determined by the insurance commissioner through looking at the rate filing in years. There was a settlement reached between the insurance commissioner and the North Carolina Rate Bureau on rates. That settlement included 3 times in 6 years double-digit increases in Eastern North Carolina. So when we saw the 3rd double-digit increase affect us in 2008, we took notice, and therefore the scrutiny of the rate filing. In 2011, the first, as I mentioned, public hearing was held on a rate filing, on a dwelling rate filing, and after 3 months of testimony, the insurance commissioner determined that he was not going to approve the rate filing. He had the option of either approving or not approving once the public hearing was called. There is a 279-page document, findings of facts from that dwelling rate filing, that I would suggest that every insurance lobbyist and every person in insurance read, because everything that we had been saying for 4 years based on our experience in Eastern North Carolina regarding rates, losses, et cetera, is justified in this findings of fact. Loss costs were overstated. There's several different overstated, excessive is used repeatedly and repeatedly in here, where the Rate Bureau could not come up with evidence to justify what they were claiming. How also it was noted in here, the $1 billion assessment that everyone hears about is already included in the rate. So you're getting it on the front end, and we keep hearing the risk of this $1 billion assessment to insurance companies statewide if we have a major loss in Eastern North Carolina. So we know that rates have not been in line with historical losses. The fact that policyholders in the rest of the state feel that they're going to subsidize our coverage, we feel is incorrect. Also, the myth that the beach plan is underfunded because of losses is absolutely not true. The beach plan, as set up just like South Carolina's wind pool plan, was set up not to operate like an insurance company, not to have money in a surplus account. In 2006, the beach plan distributed $41 million to insurance companies statewide. So if you were a company writing 1% of policies in North Carolina without ever having to write a policy in Eastern North Carolina, you were the beneficiary of a $400,000 and some check. A lot of people aren't aware of that, and then when the argument was made in 2008 after the rate filing that the rates were justified, they needed to be higher in Eastern North Carolina because of the beach plan being a ticking time bomb and there be not enough funds in the beach plan, it was never set up that way to begin with. For 20-some years, the insurance companies statewide took money out of the beach plan. When the going was good, they were able to invest that money, they were able to build buildings, et cetera. And when the going got bad, they knew they had to put the money back into the beach plan. And I think actually right now, South Carolina surplus is operating at a negative, if I'm correct. So therefore, what happened in 2009 with the passage of House Bill 1305 was a good thing. It said, okay, if the surplus is an issue, don't take any more money out of the surplus. We're going to stop that right now. You can only spend money on three things. You can spend money on reinsurance, you can spend money on operating, and you can spend money on, of course, incurred losses. What we found, though, in the past few years, which is of concern, and where that assessment then comes into play, is that the beach plan, because of the cap of $1 billion assessment now, has spent a tremendous amount of the surplus funds on reinsurance. And in talking to Gina Schwitz-Gable in her position, new position with the beach plan, we may have come up with another alternative in how we manage catastrophic risk. But when you are paying $300 million in premium and you are spending over $200 million on reinsurance, when everyone is so concerned about the pot of money growing, and you knew prior to House Bill 1305 there was $135 million being added to the beach plan surplus one year, $145 million the next year. We thought for sure by now we would have well over $1 billion and would be very insulated against losses. Last year with the huge reinsurance expense, the surplus had to be, funds had to be taken out of the surplus to actually pay for losses due to Hurricane Irene. So how we manage catastrophic risk is certainly an issue that we're certainly going to have further discussion on. There also becomes the issue about the incentive to write coverage in Eastern North Carolina. South Carolina does have, their deductible is aggregate. We pay a per occurrence wind deductible, named storm deductible. So whether it's a nor'easter, tropical storm, et cetera, the beach plan coastal property insurance pool has now become Eastern North Carolina wind pool, and this goes all the way over past Elizabeth City, North Carolina, et cetera. Farm Bureau has dropped 30,000 policyholders, State Farm, Allstate. So now the top 10 insurance companies are backing out of wind coverage, and there's some issue there and debate about the commission in the beach plan versus commission from the company. A nationwide agent just told me that their commissions have been cut to 10%. You make 13% of the beach plan for your wind, so there's something that we're going to continue discussion on. That's about all I have. I know that from the consumer perspective, basically we feel like we're stuck. We have nowhere to go. We have to pay it. We feel that coverage has been hollowed out. We pay higher deductibles now. We have higher rates, and we're very concerned about being pushed into third-party markets. Thank you very much for your time.
Thank you, Willa. I'd like to call up John Maletti now to give us more of an industry perspective and somewhat of a national as well as state perspective on this issue. Thank you, John.
And thank you, Stuart. I'm going to try to do, because I want to make sure we save some time for questions and have a little bit of panel discussion, because I think that's probably one of the more useful things we can get out of this. So I'm just going to touch on some things very briefly. I know Fletcher Willie's keeping a close eye on me, so I'm going to behave. He's right up here in the front row, and I appreciate that, Stuart. But I'm just going to touch on some things, sort of countrywide perspectives, give you a little overview, sort of what's going on around the country. I'm going to throw in just a little bit of North Carolina flavor in there, because that's probably appropriate too. So what are we basically seeing as an industry throughout the country? Catastrophes do continue to drive costs. Weather and natural disasters, we've had some incredible years during the 2000s. A lot of this information is readily available, lots of public sources, lots of places where you can find this. It's basically, you're going to hear the same story in a bunch of places. If you look at, I think one of the things that really kind of shook up the industry, when you talk about hurricanes, you sort of had a lot of people talk about Hurricane Hugo in 1989 and say, well, that kind of nudged the industry while they were sleeping. And then when, we're coming up now on a 20th anniversary of Hurricane Andrew, and that was supposedly the big wake-up call. We got thrown out of bed and we all woke up. A lot of us never really thought about the fact that you could have a series of thunderstorms and tornadoes that would hit in the same year so many populated areas and cause so much loss. And I think that's one of the things that the homeowners insurance industry is really trying to get its arms around now after looking at what happened in the last couple of years. This year, we actually started off, the first quarter of this year actually looked a lot like the first quarter of last year with tornado activity. It's tailed off a little bit. The difference, thank God, was that these tornadoes didn't hit populated areas this year. So we were having the same kind of bad weather. It's just that we were all lucky. We all tend to look at this, we're all insurance people to some degree. We hear about insurance and we think about all those losses, but when you think about the injury and death that occurs with those kind of storms, it kind of makes this insurance stuff almost seem a little bit silly. So, we really have to focus on, we do seem to be in a pattern of more extreme weather, and our population is growing, and more people are going to be in harm's way. So this is a fact. This is just a fact of life. The costs are growing. Last year was the 5th highest year on record for natural disasters. Taken as a single event, and this is what was kind of, I think, shook a lot of people up in the property business, not just homeowners, but in commercial property as well. This was that tornado season last year was the 4th costliest event in U.S. insured loss history. So you're talking about, everybody knows about Katrina, everybody knows about Andrew. This was a significant event, and it's something that we have to deal with in addition to the catastrophes that we ordinarily think about with hurricane. Part of this is the good news is there's one, I think, overarching theme I'm going to try to impress upon you. The good news is, and this is not only true in North Carolina, but it's true about every state along the Atlantic and Gulf Coast. It's not just about the coast anymore. The bad news is it's not just about the coast anymore. Okay, these costs continue to rise. The cost of repairing homes continues to rise, and these weather events continue to rise as well. So I'm just going to kind of blow through these like really quickly here. Is this because I want to kind of get to a little bit more of a conversation if we can. So these slides, I can make these slides available to you. But even just looking at the last bullet on here, Irene. Now, obviously, Irene, for anybody who was impacted by Irene, this is not to diminish, what happened to any individual. But if you think about that storm, people were really scared as it was coming. As an insurance company, especially a company like mine that's very heavily concentrated along the Atlantic seaboard in the Northeast, Irene had a pretty scary path, and it was a pretty powerful storm. It ended up, and a lot of people, either joke around about it, depending on your perspective, how Irene fizzled out. It ended up not being that big of a storm. Yet it's the 11th costliest disaster in U.S. history. I mean, think about that. Hurricane Irene. The hurricane, it wasn't a hurricane when it hit. By the time it made landfall in New Jersey after it went back out over the water, it was only a tropical storm when it made landfall in New Jersey. So this people downplayed it, said, oh, it was a lot to do about nothing, unless, of course, you were actually hurt by it. But still, think about that storm, the 11th costliest natural disaster in U.S. history. All right. It's not just about cats. Non-catastrophe loss costs, okay? We're not talking about these major events, whether they're a thunderstorm or a tornado or a hurricane. We're talking about all the other perils that the homeowner's policy covers these days. Those costs continue to rise. So we've got this weather, and we've got all these other costs out there, but we also have the non-catastrophe costs continue to rise. And this is, this is kind of countrywide. Frequency, okay, geeky insurance word, right? It means, the number of claims that are coming in the door. Frequency continues to increase at a very steady pace over the last 5 years, pretty much fairly steady. And if you look on here, these are numbers. This is from ISO Fast Track data. I'll throw a little North Carolina flavor in here. Basically, frequency, the number of claims, and again, this is non-catastrophe claims. That's the only thing I'm talking about with this particular data, just to show you it's not just about cats. So the number of claims typically being filed are increasing. North Carolina actually slightly ahead of countrywide. CW's countrywide. That's the other 49 states combined. On average, are rising at about 7.1% over a 3-year, each year for a 3-year period. North Carolina frequency is actually slightly ahead of that. So that means the number of claims on average that we're seeing for non-catastrophes is increasing. And let's just keep in mind, we're talking about, if you just think about North Carolina a little bit, okay? The last homeowners rate filing here became effective in 2009. It was filed in 2008. I might be wrong on this, but it's probably got 2007 data in it. Okay, we're in 2012 right now. And all the things I'm describing for you are happening countrywide and are also happening right here. So just think about that dynamic. You don't have to be an actuary to figure out that there's something of concern for people who are putting their money at risk in this business in North Carolina. Severity, another geeky insurance word. It just means the average cost per claim. Okay, frequency, number of claims. Severity, average cost of claims. Most of you know this, but I know we have some students. I don't know, how much they deal with this stuff. But that's going up as well. It's going up countrywide. It's also going up here in North Carolina. Again, North Carolina slightly ahead of countrywide per year. So here's sort of like the bottom line. If the number of claims is increasing and the average cost of a claim is increasing, don't have to be an actuary to figure out what's going on countrywide and also here in North Carolina. Rates need to go up in order to cover those costs. You got to expect the cost of the product to go up when all this is going on. So this is not just a North Carolina issue, it's a countrywide issue. What's happening in the marketplace? Rates and premiums are increasing. Stuart put up that slide earlier. My company follows this stuff. We're a significant writer of homeowners insurance in most of the continental United States. We have significant market shares in places like Texas and South Carolina, places in the Northeast. I can assure you that this entire homeowners industry, in the last year, there are filings that are in the high single digits, in the mid-teens, in the 20s. There are actuarial indications that are being filed with insurance departments where rates have to be approved by a commissioner. It's just that they're done, unlike North Carolina, they're done on an individual company basis with that company's actual data and loss experience, and looking at their individual needs and whether they purchase reinsurance and all the relevant factors. These are all places where we don't get to do what we want. We don't simply get to file what we want and charge what we want. We have to meet actuarial standards, and a public official, an insurance commissioner, either has to sign off on it affirmatively, or they have to say, well, I'm not going to object, because that just may be the way that particular state works. But it's a tacit approval if they're not going to basically reject your filing or oppose your filing. We are seeing 10, 15, 20% rate increases in many states. And this goes from Rhode Island, this goes to South Carolina, this goes to Texas, and right across the board. Okay, so, as we sit here in North Carolina and we think about what is going on in the homeowners insurance market, you cannot ignore what's going on in the rest of the country. Okay, I assure you, there's plenty of politics involved, as there always is in personal lines insurance. There's plenty of scrutiny. There's plenty of consumer concern and backlash and questioning. But yet, in these states, these kinds of rates are being approved. And that's because there is a fundamental understanding that the cost of this product, this policy, now covers a lot more than it ever did before. And what we're paying out on an average cost per claim, combined with the frequency and all the severity for both cats and non-cats, continues to increase. Claim costs are up and investment income is down. And, it used to be in the old days, I put up a cute little thing here. A 100 combined ratio isn't what it used to be. We used to, as an industry, to hope that we would hit a 100 combined ratio. And again, insurance geek talk. It just means all the dollars that you collect and all the dollars that you pay out for losses, expenses, and everything, it's dollar for dollar. So just think about it. We used to write a lot of personal lines insurance and just break even on underwriting, but the time differential between when we bought the premiums in and we finally paid them out in claims, that's where we made our money. So think about it. We didn't actually make it on selling the insurance product. We made it on the time value of that money. So we all know what's going on in the investment world today, and insurance companies are we're required by law to be some of the most conservative investors. Most of what we have is fixed income, bonds. We're big purchasers of state municipal bonds all around the country. There's not a lot of exotic investments that insurance companies are involved in, nor are we allowed to be involved in them. So when investment income is down, if you're running a combined ratio of 100 today, you would be lucky. One of the estimates that I read is basically 100 combined ratio today gets you about a 5% return on equity. There aren't too many Fortune 500 companies that are happy with a 5% return on equity. Back in 1979, if you were running a 100 combined ratio, you were making almost a 17% return on equity. So investment income is a key component to this, and that going down and loss costs going up. So as I said, we're seeing rate increases, high single digits, teens, and in the 20s. Overall premiums, and this is just countrywide homeowners. I'm just going to throw these numbers up here, you can see. And of course, there are a couple things that drive, I purposely said rates and premiums, because we all know that as the cost to repair a home goes up, the coverage A that we're all familiar with, as that goes up, obviously that generates more premium coming in the door, but it doesn't necessarily account for, it certainly accounts for the increase in coverage, but it doesn't account for any change in severity or frequency of claims, and that's what the key driver to an increase in the per unit cost of the insurance is, rather than just your total cost as a consumer. Underwriting standards are tightening up around the country. You're seeing companies be more selective about who gets into what program and what pricing track, and whether or not they're willing to stay on a risk after multiple losses or take on a risk that has losses. Deductibles are higher for cats and all other perils. I mean, we still live in a world where there's this expectation that maybe we should have a $250 deductible. $250 deductible came in general use in the 1970s. Adjusted for inflation, that's about a $1,500 all-peril deductible. There are lots of states where lots of insurance companies are now charging a 1% all perils deductible statewide on their new homeowners products. So deductibles and cost sharing, really we have to get this back to, and the companies seem to be moving in this direction, you've got to get back to where the product really was. And I think that's pretty much about it from my perspective. I do want to mention one thing, since we had the two folks up here from talking about residual markets. Companies pay extraordinary close attention to an individual state's residual market and how it's run. And they look at the finances of that. And you can look at reams of data and information, and you can pull out filings, and you can pull out findings of fact, so-called. But I'll tell you one thing about a place like South Carolina. And I don't know if, Tommy, I don't know if you put the reinsurance stack up there. I don't know if that was in part of your slides because we couldn't see them, but y'all saw the reinsurance stack for North Carolina. And yes, the industry has a $1 billion potential exposure. And that $1 billion potential exposure, by the way, came in 2009. And since we haven't had any rate increase, to suggest that that is somehow already baked into rates when the rates were already woefully inadequate statewide, it's sort of like, if the tree falls in a forest and you don't hear it, did it make a sound? I would submit to you right now that $1 billion continues to be free reinsurance for the residual market in North Carolina. But here's a fundamental difference. You need to know this. In South Carolina, when a Category 3 hurricane hits Charleston, okay, going to be a tough day for Travelers and every other insurance company, and certainly all the people who are in harm's way. But our focus, the industry's focus, will be primarily on taking care of our customers and paying our claims. The industry's exposure for the 1 in 200 year event from the South Carolina wind pool is $10 million. That's with an M, $10 million. That's the self-retention. So, just think about whatever else you want to think about. You think about a place where, as an insurance company, you have an opportunity to go in and make your case and prove to the regulator you need some rate, and you can get it. And your exposure to a wind pool is your pro rata share of $10 million. Compare that to North Carolina and think about if you were an insurance company, if you're running an insurance company, you're responsible for the finances of an insurance company. That's going to be relevant to you. And that's part of what every company is looking at as they look at these residual markets. So thank you. I just wanted to make that one final point, and I'm sure we'll have some panel discussion.
Up here. Thank you, John, and thank all the other panelists. We have time for some questions. I've got a couple up here that we have pre-selected. If any of you have any questions, please write them down and wave at one of the staff people. They're standing around the room, and they will pick up the questions and bring them up to me. Most of you, being insurance practitioners, know that over the last 10 or 15 years, we have largely competed in the industry, particularly on homeowners, by broadening coverages, adding additional benefits to the policy when rates have been relatively stable. There is a bill in the legislature, it's going through the legislature right now, where a request came from one of the senators to have the Rate Bureau provide a policy, rate and provide policy terms for a policy that does not include the perils of wind or hail. I'm not sure many people will sell that, but there was a consumer interest in having that. It prompted me to wonder, and I'll submit this to some of the panelists up here, many of who have had extensive insurance experience, are our products too broad? I mean, we're offering perils, we may be offering perils that we're not really collecting enough money to pay for. And if that's the case, then does the industry really need to take a look at the breadth of coverages we're providing as well as at the rate? And I'll throw that to the panel if any of you want to take a shot at that.
I'll take a shot. Look, a lot of this, and this is a very common discussion, I think, in the industry, I think, over the last 5 years. When you look at the homeowner's product, and I think about And I made the comment before about deductibles. You know, I think about my dad when he bought his first house in, 1959. I don't think he made more than $4,000 a year, and he had a $250 deductible on his house, and it basically covered fire and theft and, some basic wind perils. There wasn't mold, there wasn't all these other exotic coverages. Now, what did we do as an industry? Guilty as charged. We continued to sweeten up that product, and it made sense for a long time, and it's kind of caught up with us now. I mean, we're kind of looking at, we see the costs, we see the product that's out there, but it's really hard to put the old toothpaste back in the tube. Once you provide these kinds of coverages, once people are accustomed to $250 and $500 deductibles in this day and age, there's no risk sharing involved there. This was a risk sharing proposition when it started. So, plenty of, this is America, we like to find somebody to blame. Part of that blame lies with us as an industry. Sometimes competition does that to you, and you start laying that out. But we really do have to be realistic and think about collectively. We got to think about, what should we, what can we, what makes sense for coverage, and what makes sense for the consumer. Because you do end up with affordability issues, and affordability issues are really not in a strict legal sense or an actuarial sense. They're not relevant to the price of the product, but they sure are relevant to everything else other than the price of the product. And we do have to figure out a way to provide people with essential coverage at a price that fits in with people's basic budgets. They do have to be able to afford it, otherwise we are going to have a meltdown. But we got to start tailoring this product and people's expectations to match the risk that's being covered and the cost of covering that risk.
Can I touch on that?
Sure.
The bill in question that you referenced is actually being heard tomorrow in the House Insurance Committee at 1 o'clock. The bill, I think, basically says that if you have your mortgage paid off, that you should be allowed to purchase a fire-only policy and not include the wind. There are concerns with that, of course, because self-insuring is one thing, but what happens when you do have the loss and you don't have the money to cover or to pay for the damage? So you run that risk there. Are we going to see properties now that are not, they're not fixed up after the claim, after the loss, et cetera? So we run that risk. However, this came up, I think it was Representative Pat McElrath from Carteret County that I guess had gotten a lot of calls from people that were senior citizens on fixed incomes, and we're seeing their rates continually increase with their homeowners insurance. And when they asked, well, what if I just want to self-insure wind, they're told they can't do that. So I think she's coming from that standpoint, from hearing from her citizens. You have to understand, a comparable policy on a $250,000 policy on the coast of North Carolina can be over $3,000 with wind and fire. Inland, you're looking at like $600 and some dollars. If you go to the coastal area, say Elizabeth City, that is still part of the 18 eastern North Carolina counties in the beach plan, and you're forced into the beach plan for wind, your premium is still somewhere around $1,500, $1,600 for that same policy. So it is becoming an issue with regards to affordability in eastern North Carolina. A lot of people questioning self-insuring if they don't have a mortgage. But again, we are also concerned with that. Hearing from realtors on the coast, in Hatteras especially, in where they're looking at people coming in and making cash-only deals to purchase property because, first of all, if you don't have a mortgage, you're not required to buy insurance. And therefore, I'm hearing from some realtors that's where we're going. The concern there is what happens when there is a storm and these properties aren't insured. Will there be money available or access to capital then to repair these properties?
A couple of questions have come in. I'm going to summarize some of these questions having to do with the Rate Bureau in North Carolina. North Carolina is, if not the last state, one of the last states to have a statewide bureau to do the rate and form filings on behalf of the industry. And I'm curious. From not only the company perspective, John, but also from the Rate Bureau's perspective, if there was no rate bureau, what would be the company's reaction to that, and what problems would that create for the Beach and Fair Plan if there was not a body promulgating rates on your behalf? So, John, would you care to?
Well, you know, this is kind of an interesting issue. North Carolina is the only place, and it's the last place that has a promulgated rate. As I talk to a number of agents in this room, I mean, the interesting thing that's going on is there has been, for a number of risks, especially away from the coastal area, the bureau rate had been, you know, rich enough so that companies would voluntarily take deviations, and they would charge a number of their customers who, based upon their company underwriting criteria and how they viewed that risk, they would charge them actually less than the bureau rate. You know, when I talk to agents and I hear about what's going on in the market, it seems, you know, and I'd love to hear. I think anybody wants to chime in. I think you should. But it sounds like what we're starting to see more and more over the last year, and especially now, you're seeing companies getting off of risks. You're seeing companies eliminating deviations so that, you know, a good number of companies are up at the bureau rate. There's no more room left for deviations, and they're going to consent to rate. So, you know, if you have a bureau rate, I mean, let's just say hypothetically, I mean, we're looking at this now as a practical matter. If there's going to be any rate increase in this state for homeowners, as a practical matter, it probably wouldn't be implemented until about 2014. Okay, that's a 5-year rate freeze. I don't know of any state in the country that has a 5-year rate freeze going on homeowners insurance. So what are companies going to do? I mean, companies are going to basically take the tools that they have available to them. So deviations go and consent to rate. So what happens if, suppose we go to 2020 with no rate? I mean, what do you think will happen? You know, I mean, this is a problem with the rate bureau. I mean, right now, even if the rate bureau does a rate filing, I think the most current data they'll actually be able to produce on behalf of an industry. This is a problem when you're trying to promulgate a rate for a bunch of very diverse people. I can assure you that the financial expectations and needs of a stock company like Travelers and other stock companies are much different from a State Farm and are much different from a Farm Bureau. How we run our finances, how we reinsure, if we reinsure. So to suggest that there's this one rate that should be out there for any type of given risk really doesn't make sense. It's basically like the state saying, you know what, everybody, you're all going to sell men's suits, and everybody's going to sell a 42 regular, because that's just about the average size of a man's suit. You know, so, you know, I can work with a 42 regular. If I got somebody who's a 40 short, I can take it in a little bit, right? Because there's a little bit of a lower risk. But if I got a guy who's a 46 long, there's not enough material to go around. I mean, that's the problem with the rate bureau. And, you know, as far as I know, virtually every other residual market makes its own rate filing. They do a rate filing with the state. There's plenty of politics involved in these, I can assure you, spending many years in Texas. But they file their own rate. So, I mean, I just don't think it's the end of the world if that happens here. We'll figure out a way. Gina, as a board member, we'll figure out a way to file our own rate, and it'll be what it'll be.
You know, commenting on that, being on the commercial side for so long, we did file our own rates on the commercial side. Speaking as general manager, not on behalf of the board, it does give me some freedom not to have to deal with, like John said, the politics of the rate, in terms of I can just focus every day on working on disaster recovery as opposed to the adequacy of the rate. However, once you look at that, are we able to file our own rates? Can we file our own rates? Can we administer our own rates? Absolutely. Every other rate plan in the country except for Mississippi has a rate bureau, and they administer the plan both under Joe Shoemaker. But outside of that, the other states do have the ability to file their own rates. So I think whichever way it goes, I don't know that we have a real opinion. It works the way it works now, but likewise, we certainly are capable, able, and willing to do the will of the General Assembly and however they want us to do, whether it is continuing not to have our own rates or whether it is filing our own rates. So I guess my answer is we're more of a neutral, that we could go either way that we're directed to by the General Assembly very effectively and efficiently in doing so.
Got a question up here for Willa. One of the people in the audience wants to know if we will ever see an NC-20 property and casualty insurance company.
Well, interestingly enough, House Bill 1305 did allow for a successor organization of the beach plan if it was ever dissolved. And after speaking with actually a gentleman on the Outer Banks who is obviously retired from Lehman Brothers, the issue came up about why not have just an Eastern North Carolina mutual insurance company. But we won't see an NC-20 insurance company.
All right. One other question that I had, and I direct this to Tommy, the fairly substantial difference in geographical territory covered by your plan versus our plan would make one wonder how the what the health of the marketplace is just outside your beach plan or wind pool geographic limitations. Have you got distressed markets, or is there plenty of companies?
I don't see it as a distressed market. We certainly don't have the admitted carriers writing a lot of business close to the coast, and close is a relative term that all of them have a different idea. It could be east of I-95, it could be first-tier county, it could be 2 miles. There are several carriers that will write a little bit of property if it's not real high values, maybe a $500,000 building or a $750,000 piece of property. As long as it's superior construction, no one will touch the frame. But we just use the E&S market. Quite frankly, I've ran some quotes with some standard carriers, and they would be higher than the E&S market because, as you know, it's just an open rate there, and the market is still soft on the coast, amazingly enough. So we use the E&S markets a lot. We don't use the wind pool for 2 reasons. One, the rates are very high in most cases, particularly for commercial property. You can get a lot better rate through the E&S market. You can also get replacement cost through the E&S market that you cannot get through the wind pool on commercial property. So I think that's why you saw on that graph the commercial number of policies in the wind pool are very low compared, about the same as they were in 2003. It surprised me when I looked at that graph, though, that the homeowners, the personal lines, was that high, because we've had a lot of Florida companies come into South Carolina to write homeowners insurance. So we've got markets now. I mean, back in 06 and 07, we were losing all of our homeowners markets and had no one. Now we've got more than we can handle, and they just keep coming.
It looks like we've exhausted our time. I haven't gotten any more questions up from the floor. At this point, I'd like to thank our panelists, Gina, Tommy, Willa, and John, and call this session to close as we have run out of time, and I'll turn it back over to Tim.
Stuart, thank you for leading this. 2 minutes, and I just want to get a perspective, mainly from John and Willow. John, what would you like to see happen? Five sentences. What would you like to see happen in North Carolina to make it an attractive state for carriers to operate in?
1305 was a good bill because it created transparency, and everybody knows pretty much what's expected. You have to get back to risk-based pricing, and I'm not talking about everybody everywhere on the Outer Banks has to pay bust-out retail. We know there's a certain role for a residual market, but you need to shrink this residual market, and more people need to pay a rate that's closer to risk-based pricing. And you'll look more, and your marketplace will look more like South Carolina or Virginia.
Thank you. Willow, what would you like to see happen?
Well, in the short term, I think we certainly need to focus on the huge amount of expense for reinsurance in the beach plan. When you're taking 60 cents of every premium dollar and using it to buy reinsurance, and I understand, you know, they're looking at of which Gina just told me, lower than a $4 billion risk at this point. You know, our policyholders in Eastern North Carolina, and 67 cents on the dollar doesn't just go out of North Carolina. In most cases, reinsurance is being spent on companies out of this country. So we have to look at a better way to manage catastrophic risk, and we're not growing the surplus in the beach plan by spending such a huge amount on reinsurance. We have to look at perhaps managing risk when it happens, not if it happens. And we've talked about tax-free bonding as a possible solution to that. I'm sure the conversation is going to continue, but we certainly want to focus on that. We don't want to see year after year a Hurricane Irene, which was a Category 3 hurricane, which came up through the Sound, to have to deplete surplus funds, and then we get into a vicious cycle where we're exposing policyholders statewide more of that recoupable assessment when we keep taking money out of the surplus. So that would be my suggestion.
Thank you. Thank you for both your perspectives. We appreciate you being with us today. Thank you, Gina, and thank you, Tommy. We've got a couple administrative items to cover to wrap up the session. It's been a great session. We've enjoyed everybody being with us. We've got to thank partners, presidential partner Progressive Insurance. They sponsored today's session. Thank you so much, Progressive. He does a lot, and I just wanted to say it. Chris Meinberg, the voice of the Big I, we really enjoy him being with us. So I wish, if I had a voice like that, I could really sell some insurance, I think. Harry, will you make your way forward? I know you've got the pack raffle, and we'll share that. Just a reminder, this afternoon we've got the Young Agents Beach Party starting at 1:15, so that's the young agents and their families, fun out on the lawn. And then really tonight, you know that we're going to start 6:30 with our presidential reception. We'll move there to dinner at 7:15, and then we'll have a night of tribute where we have over 23 past presidents here to honor, and we appreciate their coming and being with us today. So come forward, let's do a 50-50 pack raffle, and we'll wrap up the morning, and everybody will enjoy their afternoon.
Mix those up real good. You got $1,045, so the payout's $525.
For $1,045 that's been raised for PAC, and half will go to the name, and I see just
That's Darcy.
Do you know that name, A&A?
I do know that name. I filled it out for her. It's Darcy, where is she?
Darcy?
With Am's Trust. She here?
We'll find her. It just says A&A on the raffle ticket, so we'll find her. Thank you for being with us this morning, and thank you for participating in PAC, and our panel in Stuart. Thank you again.
We've had a great day here in Myrtle Beach, and I hope you've benefited from this broadcast of the 2012 Annual Joint Convention. Tonight, our attendees will attend our closing banquet, Night of Tribute, honoring yesterday and celebrating today. We will honor our past presidents that are in attendance, as well as install our new officers and our new chairman, David Purni from Rocky Mount, North Carolina. We will be rebroadcasting our closing banquet tomorrow morning at 9 o'clock. So I hope you can be with us to meet your new chairman, David Purni, and also all the other officers of your association. This live broadcast of the 2012 Annual Convention has been made possible by our friends of Jackson Sumner and Associates. I hope you'll be able to take time at the end of this broadcast to see all of the names of the people that make this broadcast possible. Until tomorrow morning at 9 o'clock, I'm Kelly Erstein, bidding you a good afternoon from the Jackson Sumner studio.